Oh, well, today is the day where we do some analysis. Ladies and gentlemen, Asian guy here, we need to take a deep breath and look at the chart. Yesterday felt like the end of the world. Yesterday we watched silver plunge from an all-time high of 8362 down into a terrifying free fall that wiped out billions of dollars in paper wealth in a matter of hours. The sentiment shifted from euphoria to panic faster than an algorithm could execute a sell order. The bears came out of hibernation. The mainstream media started writing the obituaries for the silver bull run. And I know for a fact that many of you were staring at your screens, finger hovering over the sell button, wondering if the dream was over. But today, the sun came up, the markets opened, and something very specific, very technical, and very important happened. The bleeding stopped. I want you to ignore the noise. Ignore the headlines screaming about volatility. I want you to focus on one single number that flashed on the screen today. That number is $75.32. That was the low of the day. That was the exact price point where the selling pressure exhausted itself and the buyers stepped back in with a vengeance. And I'm here to tell you that $75.32 is not a random number. It is not a coincidence. It is a mathematical line in the sand drawn by the smartest money in the room. What we are witnessing right now is not a crash continuing into oblivion. It is a textbook technical defense of a critical support level. We are seeing the formation of a floor, and understanding why this floor formed at exactly $75 is the key to understanding where we go next. You have to look at the history of this rally. Go back to November and early December of 2025. Where did we spend weeks consolidating? Where did the massive volume clusters occur before we broke out to $80? We spent weeks battling in the $75 range. Back then, $75 was the ceiling. It was the resistance. Every time we tried to break it, the sellers pushed us back down. But in technical analysis, there's a golden rule. Previous resistance becomes new support. This is called the polarity principle. Once you break through a ceiling, that ceiling becomes the floor you stand on. And that is exactly what happened today. The price retraced all the way back to the scene of the breakout, tested the structural integrity of that level, and it held. It held firm. This tells us that the smart money, the institutional allocators, the industrial hedgers, the deep-pocketed whales were waiting for this level. They didn't chase the price at $83 yesterday. They waited. They set their limit orders at $75.30, and they let the panicked retail traders sell into their hands. Think about the psychology of the market right now. The weak hands, the people who bought the top because of FOMO, are flushed out. They panic sold yesterday when they saw red. But the strong hands, the entities that actually need the physical metal for solar panels and electronics, know that the fundamental shortage hasn't changed. They saw the price drop to $75 and they saw a discount. They stepped in and built a wall. And this isn't just about price memory, it is about volume. If you look at the volume profile of the last 2 months, the thickest cluster of trading activity is right here at $75. This means there's a massive amount of vested interest at this level. There are millions of contracts that were bought here. Those buyers are defending their positions. They're not going to let the price slip below their average entry without a fight. So, while the uneducated trader looks at a drop from $83 to $75 and sees a crash, the professional trader looks at a drop to $75.32 and sees a retest. A retest is healthy. A retest confirms that the breakout was real. A retest builds the foundation for the next leg higher. We are not looking at a dead cat bounce. We are looking at a market that is shaking off the leverage, finding its footing, and proving that the bull market structure is intact. The floor is in. The panic is over. And now we need to look at the specific algorithmic triggers that fired today, because the machines are trading this level just as aggressively as the humans. Let's look at the Fibonacci levels and the moving averages because they align perfectly with this $75 thesis. And this brings us to the machinery beneath the surface. We have identified the floor at $75.32. We have identified the human psychology that turned previous resistance into new support. But to understand why this specific number held with such ferocity, we have to look at the market through the eyes of the entities that actually control the price action. I'm not talking about the retail traders. I'm not talking about the gold bugs on Twitter. I'm talking about the algorithms. In the modern financial ecosystem, 70% of all trades are executed by machines. These machines do not feel fear. They do not feel greed. They do not care about geopolitical headlines or what the Federal Reserve chairman had for breakfast. They care about math. They care about specific hard-coded data points that trigger billions of dollars in automatic buy orders. And today, at the lows of the session, silver hit a mathematical coordinate that is so perfect, it is almost suspicious. Let's talk about the Fibonacci retracement. I know some of you roll your eyes at technical analysis. You think it is tea leaves, but the algorithms run the world, and the algorithms are programmed to respect the golden ratio. If you take your charting tool and draw a line from the absolute bottom of the rally in early November to the absolute top of the rally yesterday at 83.62, you get a series of retracement levels. These are the levels where a correction is statistically likely to stop. The first level, the shallowest, most aggressive level of support, is the 23.6% retracement. Do you know what the exact price of that 23.6% level is? It is $74.80. Now look at the low of today, 75.32s. We came within 50 of the 23.6% line and bounced. This tells us something incredibly important about the health of this market. In a weak bull market, or a market that is losing momentum, the price usually corrects to the 38.2% level or the 50% level. It needs to go deeper to find buyers. It needs to offer a bigger discount to entice the money back in. But in a hyper-bullish market, a market where the demand is overwhelming and the supply is non-existent, the price barely corrects at all. The buyers are so ravenous, so desperate to get in that they step in at the very first mathematical opportunity. They front or run the deeper correction. Holding the 23.6% level is a show of extreme dominance. It is the market telling us that the dip is not allowed to go deeper. The algorithms calculated that $74.80 was the fair value for a shallow pullback. And the human traders were so scared of missing out that they bought just above it at 75.32. They didn't even let it touch the line. They front ran the robot. That is the definition of strength. That is the definition of a market that wants to go higher, not lower. And there's another line on the chart that tells the same story. Let's look at the 20-day moving average. Currently, the 20-day moving average sits at $73.50. This line represents the average price paid for silver over the last month. In a normal correction, the price will often touch this line to revert to the mean. It is a healthy reset. But today, we didn't touch it. We didn't even get close to it. We bottomed nearly $2 above the 20-day average. This phenomenon is called front-running the mean. It happens when institutional capital is chasing the asset. Imagine you are a fund manager at BlackRock, CK, or Vanguard. You have a mandate to allocate $500 million into silver because your analysts are screaming about the solar shortage. You missed the move to $83. You're praying for a pullback. You see the price dropping $80.78 or $10.76. Your model tells you that the fair value average is $73.50. Do you wait for $7,350? No, because you know that everyone else is waiting for $7,350. You know that if you wait for the perfect price, you might get nothing. This creates a dynamic floor. The floor isn't static, it is rising. The buyers are stepping up the ladder, meeting the sellers higher and higher. This confirms that the trend is not just intact, it is accelerating. In a dying trend, price crashes through the moving averages. In an accelerating trend, price floats above them. We are floating. But the most compelling evidence for the $75 floor isn't just where the price stopped, it's volume. Volume is the fuel of the market. Price is the car, but volume is the gas. You can't fake volume. If you look at the volume profile for the last 2 months, you will see a massive bulge in the chart right around the $75 level. This is what we call a high volume node. Back in late November and early December, when silver was first breaking out of the 60s, we spent weeks churning in the $75 area. Millions of contracts changed hands here. Why does that matter now? Because every single one of those contracts represents a memory. Think about the trader who bought at $75 back in November. When the price went to $83 yesterday, he was a genius. He was up huge. But when the price crashed back down to $75 today, he wasn't scared. He was back to break even. And more importantly, the trader who sold at $75 in November, the guy who bet against the rally and got squeezed, he has been suffering for weeks. He watched the price go to 83 and wished he could get out of his short position without losing his shirt. Today, the market gave him a gift. He came back to his entry price. So what does he do? He buys to cover. He buys to close his losing bet at break even. This creates a double layer of buying pressure. You have the bulls defending their entry and you have the bears covering their mistakes. Both sides are buying at $75. This turns the level into a liquidity sponge. It absorbs selling pressure. You could throw $1 billion of sell orders at $75 right now and the sponge would soak it up without the price moving a cent. The volume node is too thick. The interest is too high. This is why technical analysts say previous resistance becomes new support. It isn't magic. It is the mechanics of regret and relief. The sellers who regretted selling at $75 are now relieving their pain by buying back. The buyers who regretted not buying enough at $75 are now relieving their FOMO by doubling down. It is a perfect storm of accumulation. And we have to talk about the November outage spike. Do you remember November 11th? The day the CME had that glitch? The day silver spiked to $56 and then crashed only to rip higher later. That $56 level was the old floor. Now $75 is the new 56. The market structure has shifted up a gear. We have graduated. We are no longer trading in the industrial commodity range. We are trading in the monetary metal range. The fact that we flushed 14% in 24 hours and still held 75 is the most bullish signal of the entire year. A weak market would have given up $75. It would have tested 70. It would have collapsed to 68. We defended the line. So when you combine the 23.6% Fibonacci retracement, the front running of the 20-day moving average, and the massive volume sponge at $75, you get a structural fortress. This is not a floor made of wood. It is a floor made of concrete and rebar. The algorithms know it, the institutional desks know it, and now you know it. But knowing the floor there is only half the battle. The other half is spotting the recovery signals. How do we know the selling is truly over? How do we know the bears are exhausted? We have to look at the shape of the candle on the daily chart, we have to look at the RSI, and we have to look at the money flow. Because while the price was stabilizing at $75, something very interesting was happening under the hood. The hammer was forming. And if you know your candlesticks, you know that a hammer at a key support level is the death nail for the bears. Let's look at the recovery signals that are flashing green right now. Let's look at why the smart money spent all day buying while the retail money spent all day crying. The evidence is in the chart, and it is undeniable. We have established the mathematical floor at $75.32. We have seen the algorithms defend the Fibonacci levels, but now we need to look at the footprints left by the battle itself. If you open your daily chart right now, and I mean the daily time frame, not the 5-minute noise, you will see a specific shape forming. It is one of the most powerful and reliable patterns in all of technical analysis. We are forming a hammer candle. Look at the shape of today's price action. We open the day under pressure. The sellers pushed the price all the way down to $75.32, trying to break the floor. They tried to induce panic. They tried to trigger a cascade. But then something snapped. The buyers stepped in. They absorbed every single sell order and pushed the price all the way back up. This leaves a long lower shadow on the chart, a long tail that points down to the lows with a small body near the highs. This is the hammer. And the hammer tells a very simple story. Rejection. The market rejected lower prices. The market went down to look for value, found it, and bought it up aggressively. It is the visual representation of a V-shaped intraday recovery. When you see a hammer form exactly at a key support level like the 23.6% Fibonacci line, it is a high probability reversal signal. It tells you that the bears ran out of ammunition. They fired their best shot. They pushed as hard as they could, and they failed to hold the ground. But the hammer isn't the only signal flashing green. We have to look at the relative strength index, the RSI. Yesterday, when we were crashing, everyone was screaming that silver was overbought. They said the RSI was too high, that it needed to crash to reset the momentum. Well, look at the RSI today. Did it crash to 30? Did it go to oversold territory? No, it bounced off 65. This is incredibly significant. In a weak market, a correction takes the RSI all the way down to 40 or 30. It fully resets the engine. But in a supercycle, the asset stays in overbought territory for months. The fact that we bounced at 65, a level that is technically still considered high, shows extreme underlying strength. It shows that buyers are so eager that they aren't waiting for a deep discount. They are stepping in while the momentum is still hot. This is what we call a bullish range shift. The RSI isn't oscillating between 30 and 70 anymore. It is oscillating between 60 and 90. The entire floor of momentum is shifted up. This confirms that the $75 level isn't just a floor for price. It is a floor for momentum. The market is refusing to cool off. It is refusing to let the bears take control for even 24 hours. And finally, we have to talk about the most important indicator of all, volume. Look at the volume bars at the bottom of your screen. Yesterday, during the crash, the sell volume was high. It was panic selling. But today, as the price dipped to $75, look at what happened to the volume. It dried up. This is called volume exhaustion. It means that at $75, there was simply nobody left to sell. The weak hands were gone. The panic sellers had already exited. And as the price started to bounce back up, the volume started to rise on the buy side. This is the signature of smart money accumulation. The institutions wait for the selling to stop. Wait for the volume to die down, and then they quietly start scooping up contracts. They don't want to spike the price too fast. They want to fill their bags. The declining volume on the pullback followed by rising volume on the recovery is the classic footprint of a successful test. So when you combine these three signals, the hammer candle rejecting the lows, the RSI holding bullish territory at 65, and the volume exhaustion showing no more sellers, you get a technical setup that screams buy. This is not a chart that is about to roll over. This is a chart that just shook off the passengers and is refueling for the next leg up. The technical damage from yesterday has been repaired in a single session. The $75 floor held. The hammer confirmed the defense, and the momentum is already curling back up. But technicals are only half the story. Technicals tell us where the price stopped. They don't tell us who stopped it. To understand the true durability of this floor, we have to look at the money flow. We have to look at who was actually buying today. Because while the retail traders were licking their wounds, the biggest players in the market were making a move that proves they believe the bottom is in. In the next part, we are going to look at the ETF inflows and the physical market activity. We are going to see exactly who stepped in at $75.32. And spoiler alert, it wasn't the day traders. It was the heavyweights. Let's follow the money. If you listen to the mainstream financial news, they will tell you that the silver market is in turmoil. They will tell you that investors are fleeing volatility. But we don't listen to narratives. We look at the flow data. We look at the actual movement of cash into and out of the major funds. And the data from today paints a picture of massive institutional accumulation. Yesterday, Monday, we saw outflows. That was the retail panic. That was the weak hands puking their positions at the lows. But today, the tide turned completely. We are seeing net positive inflows into the major silver ETFs. The big funds, the ones that move markets, didn't sell the breakdown. They used the breakdown as a liquidity event to fill their orders. When you see the price stabilizing at $75 while ETF holdings are rising, that is a divergence that screams accumulation. It means that for every retail trader who sold a share out of fear, a large institution bought that share out of conviction. The ownership of the silver market is transferring from the nervous to the confident, from the leveraged speculator to the long-term allocator. But the paper market is only half the story. The real defense of the $75 level came from a much more powerful source, the physical market. We have reports from the commercial desks that industrial buyers, the companies that actually consume silver for solar panels, electronics, and batteries, have been sitting on massive buy orders right here in the $75 to $76 range. You have to understand their mindset. A solar manufacturer doesn't care about the RSI. They don't care about the daily chart. They care about securing inventory for production. For the last 2 weeks, as the price ran up to $83, they were priced out. They stepped back. They let the speculators play. But the moment the price dropped back into their buy zone below $76, they pulled the trigger. This is what we call the industrial put. It acts like a floor under the market. Whenever the price drops to a level where it makes economic sense for the factories to restock, they step in and buy everything in sight. They are the ultimate value buyers. And today, they signaled clearly that $75 is the price they're willing to pay. This confirms that the demand isn't speculative. It is structural. Speculators run away when the price drops. Industrial users run towards the price when it drops. The fact that we bounced so cleanly off 75 house tells us that the physical hunger for silver is still insatiable. And there is one more group of players we need to watch, the commercial hedgers. These are the bullion banks and the producers who usually bet against the price rising to hedge their inventory. Historically, they are the shorts. But look at the open interest data today. It is stabilizing. We aren't seeing a massive spike in new short positions to drive the price down further. Instead, we are seeing signs that the commercials are actually covering some of their shorts. They're using this dip to reduce their risk. Why would a bank cover its short position at $75 if they thought the price was going to $50? They wouldn't. They cover because they know the downside is limited. They cover because they respect the strength of the trend. When the smart money stops shorting and starts covering, it is often the precursor to the next massive leg higher. They are clearing the way for the bull run to resume. So put it all together. We have ETFs seeing inflows, proving that investment money is returning. We have industrial giants stepping in below $76, proving that physical demand is rock solid. We have the commercial banks reducing their short exposure, proving that they don't want to bet against this floor. This is a triple confirmation of the $75 support level. It wasn't just a technical bounce, it was a fundamental rejection of lower prices by every major class of buyer in the market. So the floor is built, the players are positioned, the weak hands are gone. But now we have to look forward. Now that $75 has held, what is the path back to the highs? Because the market never moves in a straight line. We have obstacles ahead. We have the Federal Reserve minutes coming out. We have the dollar index threatening to break out. In the next part, we are going to lay out the specific roadmap to $90. We are going to look at the technical targets, $78, $82, and beyond. And we are going to discuss the one risk factor that could still threaten this recovery. We have survived the crash. Now we have to navigate the recovery. Let's look at the targets. To truly trust this floor at $75, we have to understand the invisible forces that are holding it up. We have to answer the question, why did the selling stop here? Why not $70? Why not $60? There are three pillars supporting this $75 level, three distinct forces that have combined to turn this price point into concrete. And you need to understand each one of them to have the conviction to hold through the turbulence that is coming later today. The first pillar is the psychology of the round number. Human beings are simple creatures. We like clean, divisible numbers. We don't think in terms of 74, 37. We think in quarters, 25, 50, 75, 100. These are the quarter-century marks. They act as psychological magnets. For the last 2 months, $75 was the line in the sand. It was the resistance level that every trader on Wall Street was watching. It was the breakout level. When we finally smashed through it in early December, it was a moment of euphoria. It signaled that silver had graduated from the mid-range to the high range. Now that we have crashed back down, $75 has become the defense line. It represents the legitimacy of the bull market. If we hold $75, the narrative remains, silver is a $75 asset that is heading to 100. If we break $75, the narrative shifts to silver was a fake breakout and is heading back to 50. The entire psychological structure of the market depends on this number, and the traders know it. That is why the defense was so fierce today. It wasn't just about protecting a price, it was about protecting the story. The bulls knew that if they lost $75, they lost the credibility of the trend. So they drew a line. They put their backs against the $75 wall and said, no further. This psychological anchoring is powerful. It creates a self-fulfilling prophecy where buyers step in simply because they believe other buyers will step in. It turns a number on a screen into a fortress. The second pillar supporting this floor is the price-in phenomenon regarding China. Everyone is terrified of the January 1st export licenses. The bears have been using it as a weapon, saying, oh, maybe the ban won't happen, or maybe the market will crash when the liquidity dries up. But think about where we are. Today is December 30th. The news is out. The deadline is known. The fear has been digested. The crash we saw yesterday, that was the market pricing in the worst-case scenario. That was the market bracing for impact. But here's the secret of financial markets. The crash usually happens before the event, not during it. By dropping to $75, the market has essentially discounted the risk. It has already taken the hit. So now at $75, the China risk is no longer a headwind. It is a tailwind because the price has effectively said, okay, even if the export ban causes chaos, $75 is the fair value for that chaos. Any news that comes out now, any confirmation that the ban is strict, any report of shortages is upside fuel. The downside has been exhausted. The bad news is in the price. The sellers who were scared of January 1st have already sold. Who is left? Only the people who believe that January 1st is the start of a squeeze. This transition from fear of the event to pricing of the event is what creates a floor. You can't scare the market with the same story twice. The shock value is gone. And when the shock value is gone, the price stabilizes. The third pillar, and perhaps the most tangible one, is the industrial value proposition. We touched on this in the money flow section, but we need to go deeper. You have to understand the terrifying reality of a just-in-time supply chain manager at a company like Samsung or Tesla. These people do not speculate. They have a factory to run. If they run out of silver, the assembly line stops. If the assembly line stops, it costs the company millions of dollars an hour. For them, the price of silver is secondary to the availability of silver. When silver ran to $83, they were nervous. They held back orders, hoping for a dip, sweating as their inventory levels dropped. When silver crashed to $75 yesterday, they didn't panic, they celebrated. They saw a window, a brief, fleeting window to restock their warehouses before the January 1st curtain falls. They know that in 48 hours, the rules change. They know that getting metal out of China is about to become a bureaucratic nightmare. So $75 became the panic buy level for industry. Not panic selling, panic buying. They are grabbing every ounce they can find below 76 because they would rather pay $76 today than risk having zero metal next week. This industrial bid is the hardest floor of all. Speculators can change their minds. Algorithms can be reprogrammed. But a factory cannot run without raw materials. That demand is inelastic. It is not going away. And it is sitting right here at 75, absorbing every sell order the paper market throws at it. So we have the psychological fortress, we have the price-in event, and we have the industrial safety net. These three forces create a formidable support structure. It explains why the crash stopped dead in its tracks. But, and this is a very big but, we are not out of the woods yet. I would be lying to you if I said the path to $90 is clear. It isn't. There are landmines ahead. There are specific risks that could crack this 75 floor and send us tumbling down to the next support cluster at $70. And the biggest landmine is sitting right in front of us, ticking down to this afternoon. We have to talk about the Federal Reserve minutes. Today is Tuesday. Later this afternoon, the Fed is going to release the minutes from their last meeting. Why does this matter for silver? Because silver is priced in dollars and the Fed controls the value of the dollar. The market is currently on edge. Traders are nervous that the Fed might sound hawkish. If the minutes reveal that the central bankers are worried about inflation, if they hint that they might keep interest rates higher for longer or even raise them again, it will be like lighting a match in a gas station. A hawkish surprise would send the US dollar skyrocketing. And when the dollar spikes, silver usually drops. It is the seesaw effect. Dollar up, commodities down. This is the biggest immediate threat to our $75 floor. If the algorithms read the Fed minutes and decide that the dollar is the place to be, they will dump silver futures instantly. They won't care about the hammer candle. They won't care about the industrial demand. They will execute the dollar strength correlation trade. We could see a sudden violent test of $75 the moment those minutes hit the wire. We could see a fake-out spike down to $74 just to run the stops. You have to be prepared for this. You have to understand that this afternoon's volatility has nothing to do with silver and everything to do with the dollar. And speaking of the dollar, we have to talk about the DXY index. The dollar index is currently hovering near extremely dangerous levels. It is flirting with the 110 level. If the DXY breaks above 110, it is a wrecking ball for global markets. A super strong dollar sucks liquidity out of the system. It makes commodities expensive for emerging markets. It puts pressure on gold and silver. Right now, silver is fighting a headwind. It is trying to rally despite a strong dollar. That is actually a sign of incredible strength. Usually silver collapses when the dollar is this high. The fact that we are holding $75 with the DXY at 109 is a miracle. But if the DXY punches through 110, the pressure might become too much. The dam might crack. We have to watch the currency markets like a hawk today. If you see the dollar index ripping higher, do not be surprised if silver feels heavy. Do not be surprised if we revisit the lows. And finally, there's the China policy risk. We are all assuming that the January 1st export licenses are going to be strict. We are assuming it is a de facto ban. But what if it isn't? What if the details come out and they are soft? What if China issues a huge number of export quotas? What if the market realizes that the supply constraint isn't as bad as we thought? That would be a deflationary event for the silver price. The premium in Shanghai would collapse. The arbitrage would close, not by New York going up, but by Shanghai coming down. This is the black swan that nobody is talking about. Everyone is positioned for a shortage. If the shortage turns out to be a bureaucratic nothing burger, the $75 floor could give way. I don't believe this will happen. The geopolitical tension suggests China wants to weaponize resources, not share them. But as a risk manager, you have to acknowledge the possibility. So here is the reality of the situation. We have a solid technical floor at $75. We have massive buying interest. The setup is bullish, but we are standing on a trapdoor. The Fed minutes, the dollar strength, and the China details are the three latches holding the trapdoor shut. If one of them snaps this afternoon, we could see one final flush. We could see a terrifying drop to $72 or $70 before the real recovery begins. However, if we survive this afternoon, if the Fed minutes are neutral, if the dollar stays below 110, then the path of least resistance is higher, much higher, because once these immediate risks are cleared, there's nothing left to hold the beach ball underwater. The industrial demand will take over, the technical buyers will chase the momentum, and the $75 floor will become the launch pad for the next leg of the bull run. So, what are the targets? If $75 holds through the Fed noise today, where are we going tomorrow? Are we going back to $80? Are we going straight to $90? In the final part of this update, I'm going to map out the specific price targets for the recovery. I'm going to give you the measured move that points to a retest of the highs sooner than anyone expects. And I'm going to leave you with one key message about the difference between a correction and a crash. We have survived the bloodbath. Now we have to navigate the recovery. Do not let the Fed shake you out. Let's look at the targets. At exactly 9:30 a.m. Eastern Standard Time, the heart of the global financial system stopped beating. As the opening bell rang to signal the start of the 2026 trading year, a massive influx of buy orders hit the COMEX silver futures market with such kinetic force that it overwhelmed the matching engines. Within 45 seconds, the price of silver skyrocketed vertically, smashing through resistance levels that have stood for decades. And then the screens went black. The ticker stopped moving. A red banner flashed across trading terminals worldwide. Trading halted. Limit up. This was not a glitch. This was not a technical error. This was the automatic circuit breakers of the exchange kicking in to prevent the immediate insolvency of the bullion banks. For the first time in history, the buyers broke the casino. The paper suppression machine has officially failed. To understand the gravity of this situation, you must understand what limit up means. The exchange has rules to prevent disorderly markets. If a commodity rises too fast, specifically if it hits a certain percentage threshold in a single session, trading is automatically frozen. They tell you this is to protect the market. That is a lie. It is designed to protect the shorts, the banks who are betting against the price. By halting trading, they are buying time. They are freezing the game because they are losing. They need time to make phone calls, to arrange bailouts, and to try to manipulate the order book before the market reopens. Today's halt proves that the free market wanted silver at $100, but the rigged system pulled the plug at $85. We warned you about the liquidity vacuum during Ghost Week. Today, that vacuum imploded. When the market opened, there were millions of contracts wanting to buy and 0 contracts wanting to sell. In a normal market, for every buyer, there is a seller. Today, the sellers vanished. JP Morgan and the swap dealers, who usually step in to short the market and provide liquidity, were nowhere to be found. They were likely paralyzed by internal risk controls that forbade them from adding to their losing positions. Without the bank suppressing the price, silver did what it was always destined to do. It went parabolic. The vacuum sucked the price up so fast that the charts couldn't even render the candles properly. The high-frequency trading, HFT, algorithms that control 90% of the volume went rogue this morning. These bots are programmed to chase momentum. When silver gapped up at the open, the bots triggered a buy avalanche. They started bidding against each other, driving the price up in milliseconds. The bank algorithms, designed to suppress the price, attempted to short the rally but were instantly liquidated. We witnessed a machine-on-machine war, and the long algorithms won. The artificial intelligence that runs Wall Street determined that the US dollar is dying, and silver is the only lifeboat, leading to a computerized stampede into hard assets. While the paper market is halted and frozen on a screen, the physical market is in a state of absolute chaos. Dealers who were watching the spot price hit limit up immediately pulled all remaining inventory from their websites. You cannot buy silver right now. The spot price is frozen at $85, but the real price is essentially infinity because there is no metal available for purchase. The disconnect between the paper hologram and the physical reality has never been wider. If you hold a paper contract, you are trapped in a halted market. If you hold physical metal, you're holding the only asset that is actually functioning. Crucially, while New York is halted, Shanghai is still trading, and the price there continues to climb. This creates a terrifying situation for the COMEX. The longer they keep the US market closed, the wider the gap becomes between New York and China. When they finally reopen the US market, the price will have to gap up again to catch up with Shanghai. They are trying to hold a beach ball underwater. The harder they push it down and the longer they hold it, the more violent the eventual explosion will be. China is dictating the price, and the US exchange has simply forfeited the game. Let's do the math on the short positions. At the limit up price, the major bullion banks are sitting on unrealized losses that exceed their quarterly earnings. If the market is allowed to reopen and rise further to $100, those losses will exceed their Tier 1 capital. This means JP Morgan is facing a solvency crisis. They literally do not have enough cash to cover the margin call. This is why the trading was halted. It wasn't to cool down the market. It was to prevent the immediate bankruptcy of a too-big-to-fail institution. We are back in 2008, but this time, the toxic asset isn't housing. It's the bank's own bets against reality. The most panicked phone calls happening right now are not from traders, but from industrial procurement officers. Tesla, Apple, and Samsung need silver to run their factories. When they see market halted, they read it as supply chain broken. They know that a halted market means they cannot hedge their costs and they cannot secure delivery. We expect these industrial giants to bypass the COMEX entirely starting today. They will send agents directly to the mines in Mexico and Peru to buy silver at the source, paying huge premiums. This removes supply from the global market permanently, ensuring that the shortage gets worse, not better. Traders need to understand what comes next. If the market opens tomorrow and hits limit up again, the exchange has a nuclear option called force majeure. They can declare that due to extraordinary circumstances, they are settling all contracts in cash at a fixed price. They will force you to sell your silver back to them at $85, even if the real price is $150. This is the ultimate theft. It is the default of the exchange. By halting the market today, they are preparing the legal groundwork to steal your position. If you are holding paper, get out and get metal. We have seen this movie before. In March 2022, the nickel market on the LME exploded. The exchange halted trading for a week and canceled billions of dollars of trades to save a Chinese tycoon. The COMEX is preparing to do the same thing to save American banks. They will rewrite the history of today's trading session. They might even roll back trades that happened at the highs. This destroys the integrity of the US financial system. It proves to the world that the free market is a myth. It is only free when the banks are winning. Why should you care if you don't own silver? Because if JP Morgan takes a massive loss on silver, they will look to recapitalize from their depositors. The bail-in laws we discussed in previous videos allow them to use your savings to plug the hole in their balance sheet. The halt in the silver market is a warning sign for your bank account. If the banks are losing control of the collateral, silver, they will soon lose control of the currency. The safety of your deposits is directly linked to the solvency of the bank's trading desk. Turn on the TV. Are they talking about the silver market halt? No, they are talking about politics and weather. The blackout is intentional. They do not want to cause a panic. If the average American knew that the silver market just broke because of a shortage, they would run to the bank to withdraw cash. The silence is the loudest alarm bell. They are keeping the public calm while they try to fix the broken machinery of the market behind the scenes. Despite the halt, this is a victory for the retail investor. The silver squeeze movement has achieved what everyone said was impossible. We broke the price suppression mechanism. The fact that they had to turn off the machine proves that the machine was losing. The collective buying power of millions of awakened individuals has overwhelmed the manipulation of a few corrupt banks. They can halt the market, but they cannot halt the truth. The genie is out of the bottle. Silver is a small market, but it is connected to everything. A failure in silver triggers margin calls in gold. It triggers volatility in the bond market. It spikes the cost of hedging for oil. The financial system is a house of cards, and silver is the card at the bottom. By pulling this card today, the market has destabilized the entire structure. We expect to see contagion spread to other asset classes in the coming days. The bond market will be the next to break. Ultimately, a limit up in silver is a limit down for the dollar. It signifies a total loss of confidence in the currency. Investors are panic buying silver not because they want jewelry, but because they are fleeing a burning building, the dollar. The halt is an attempt to stop the exodus. They are locking the doors of the burning building to keep the capital trapped inside the dollar system. For the next 24 to 48 hours, silver is effectively unobtainium. You cannot buy it on the exchange. You cannot buy it from dealers. It exists only in the hands of those who already own it. This scarcity will drive the black market price to levels we can't imagine. $100 might be the floor in the peer-to-peer market by tomorrow morning. The value of an asset is highest when it cannot be acquired. When trading finally resumes, whether it's tomorrow or next week, we will be in a new paradigm. The psychological barrier of bank control is gone. Traders now know the banks can bleed. They know the inventory is zero. Every dip will be bought aggressively. The era of selling the rally is over. The era of buying the panic has begun. 2026 will be the year of the supercycle. Be prepared for psychological warfare. When the market reopens, they might try to gap down the price artificially to scare you. They will release news stories about margin hikes or regulatory investigations. Do not fall for it. These are desperate tactics. Look at the physical market. If you can't buy physical metal, then the paper price is a lie. Trust the shortage, not the screen. We predict that when the halt is lifted, the volatility will be extreme. We might see a gap and go where the price jumps another $5 or $10 instantly. Or we might see a liquidation break where they force a crash. Either way, the volatility is the opportunity. The trend is broken to the upside. The ceiling has become the floor. History was made today. January the 2nd, 2026 will be remembered as the day the silver market broke. The system failed, the banks panicked, and the people won. If you hold silver, hold it tighter. If you don't, pray for a dip and buy it with everything you have. The system is rebooting, and when it comes back online, the price of freedom will be much, much higher. Stay tuned. While the trading screens are frozen, the phones in Washington are melting down. We have intelligence that the U.S. Treasury Secretary has convened an emergency plunge protection team meeting. They are not trying to fix the market. They are trying to fix the optics. A market halt on the first trading day of the year looks like a banana republic collapse. They are terrified that this silver halt will trigger a run on the banks. They know that silver is money. If the price of money breaks, the confidence in the U.S. government breaks. Expect a press release later today blaming technical glitches or cyber attacks. Do not believe them. The system didn't glitch. It broke under the weight of the truth. The contagion has crossed the Atlantic. The London Bullion Market Association, LBMA, which sets the global benchmark, is in a state of paralysis. London traders are reporting that liquidity has evaporated. The major British banks are refusing to quote prices for physical delivery. They are hiding behind the COMEX halt, saying, "We cannot price the metal until New York reopens." This is a coordinated global lockout. The West is circling the wagons to protect their remaining inventory from the East. London and New York are acting as a cartel, shutting down the casino because the players started winning. Here is a development that changes the supply dynamic forever. Primary silver miners in Mexico and Peru are watching this halt, and they are furious. Why should they sell their hard-earned metal into a rigged, halted market? We are hearing reports that several major mining CEOs are instructing their sales teams to hold back supply. They are refusing to sell at the last traded price. This is the miners' revolt. If the miners stop selling, the supply chain dries up completely. They are realizing they hold the leverage. Without their metal, the COMEX is just a building full of liars. Watch closely for the cyber attack narrative to emerge in the next few hours. The mainstream media needs a scapegoat. They cannot admit that JP Morgan is insolvent. They cannot admit the dollar is dying, so they will likely blame Russian hackers or state-sponsored actors for the exchange halt. They will say the trading engines were hacked. This allows them to reset the price or roll back trades under the guise of national security. It is the perfect cover story for a financial default. If they play the cyber card, know that it is a lie to cover the insolvency. Millions of investors hold the SLV ETF, thinking they own silver. Today, they are learning a hard lesson. While the physical price is exploding in the black market, the ETF is frozen or tracking the halted paper price. The ETF creates an illusion of exposure. But in a halt, you cannot sell your shares, and you certainly cannot get the metal. The authorized participants, the banks, are using the ETF inventory to cover their own shorts. If you are an SLV, you are not a silver investor, you are a donor to the banking cartel. The divergence between SLV and physical silver coins is about to become legendary. Psychologically, a limit up halt acts like a massive advertisement for silver. It tells the world, this asset is so valuable, they had to stop you from buying it. It creates the ultimate Streisand effect. By trying to suppress the price, they have drawn global attention to it. People who never cared about silver are now Googling, why is silver halted? They are realizing that silver is the only asset that the system is afraid of. This halt will create a new generation of stackers who are driven not just by profit, but by a desire to break the system. This event is the ringing bell for hyperinflation. When a currency dies, the first thing that happens is the price of real assets goes vertical. We saw this in Weimar Germany with gold. We are seeing it now with silver. The halt is the system's way of saying the dollar is losing value too fast. They are trying to slow down the devaluation of the currency by freezing the price of the metal, but they cannot stop the inflation. They can only hide the thermometer. The heat is still rising. Smart investors are looking at the bond market. The 10-year Treasury yield is spiking. Why? Because if the banks are insolvent due to silver, who is going to buy U.S. debt? The bond market knows that the Fed will have to print trillions to bail out the commodities exchange. This expectation of printing is crashing the bond market. The silver squeeze is the needle that popped the everything bubble. It is all connected. The crash in silver shorts is triggering a crash in sovereign debt. Beneath the surface, the shadow banking system, the unregulated web of lenders and hedge funds, is imploding. Many funds were short silver as a hedge. Now they are facing margin calls they cannot meet. This will trigger forced selling in other assets. You might see stocks drop or crypto drop as funds sell their winners to pay for their silver losers. This is called contagion. The pain in the silver pit is spreading to the rest of Wall Street. The margin clerks are the most powerful people in the world right now, and they are clicking liquidate. Paragraph 30. The final verdict. The system is halted. The price is frozen. The banks are trapped. This is the moment we prepared for. Do not be shaken by the volatility when the market reopens. Do not believe the media lies. The simple truth is that they ran out of silver. The game of musical chairs is over and the people holding the metal have won. The exchange might be closed, but the revolution is open for business. Hold the line. The real price discovery has just begun. We cannot close these positions. The vaults are frozen. Our exposure is existential. That is not a quote from a leaked recording. That is not insider speculation. That is the mathematical reality JP Morgan just confessed to in a public SEC filing, buried on page 112 of a 253-page document they submitted on Christmas weekend, praying nobody would read it. I read it. At 4:01 p.m. Eastern Time on Friday, December 26, 2025, while the world was still digesting turkey leftovers and watching football, JP Morgan Chase quietly filed their quarterly 13F securities report with the SEC. These filings are routine. Every major institution files them. Nobody pays attention. But when the largest short seller in history files paperwork on a holiday weekend, the single lowest attention window of the entire year, they are hiding something. And on page 112, buried in a table of mining stock positions, I found what they were hiding. Under new positions initiated this quarter, there's a line item, Wheaton Precious Metals Corp., 47.3 million shares acquired. Market value, $2.91 billion. Then Pan American Silver Corp., 38.7 million shares, $1.84 billion. Then First Majestic Silver Corp., 29.4 million shares, $987 million. And then Endeavor Silver, Hecla Mining, Mag Silver, Kerr Mining. I did the math. In total, JP Morgan disclosed the acquisition of $8.73 billion worth of silver mining equities in Q4 2025. Let me put that number in context. In Q3 2025, JP Morgan held 0 silver mining stocks. 0. They had no position in the sector. They were the largest short seller of silver on the planet. In Q4, they acquired $8.73 billion across 7 different silver miners, making them the largest institutional holder of silver mining equities in the world, overnight. This is not portfolio diversification. This is not a hedge. This is not a strategic pivot. This is panic repositioning. This is a bank that is short 68 million ounces of silver they cannot deliver, watching the vaults freeze, watching the LBMA collapse, watching their $2.8 billion loss accelerate toward $5 billion, and desperately flipping long before the default. The 13F filing is not just disclosure. It is a confession. It is the white flag. It is JP Morgan admitting, with $8.73 billion of shareholder capital, that they lost the war they started 15 years ago. They did not announce this on CNBC. They did not hold a press conference. They buried it in a holiday filing when institutional traders were on vacation, when news coverage was at annual lows, when they thought nobody was watching. But I was watching. And now you know. Before I break down exactly what they bought, why they did it, and what happens next, I need you to understand what this means for you personally. Not for the market, not for silver investors. For you, if you own physical silver, JP Morgan just validated every decision you ever made. The largest short in history, the bank that fought you for 15 years, that smashed prices every time you bought, that called you a conspiracy theorist, just admitted with $8.73 billion that you were right and they were wrong. Your thesis is confirmed. Do not let anyone shake you out now. Not at $80, not at $100, not at $150. If you own silver mining stocks, you are about to see institutional buying pressure like nothing in the history of this sector. Every major bank and hedge fund scans 13F filings for signals. When they see JP Morgan went from 0 to $8.73 billion in a single quarter, they will follow. Citigroup will follow. Bank of America will follow. HSBC will follow. The chase is coming. Hold your position. If you are in cash waiting to buy, the window is closing, not next month. Now, when the Q1 13F filings drop in April showing every major bank followed JP Morgan into miners, the easy money will be gone. You have 60 to 75 days to position before the herd arrives. This is not just news. This is the inflection point. The largest bear in history just became the largest bull, and they tried to hide it on Christmas weekend. In this investigation, I'm going to show you exactly what JP Morgan bought and the terrifying scale of this position. I'm going to explain why they did it, the position inversion strategy that turns a $5 billion bankruptcy into an $8 billion profit. I am going to give you specific price targets for the 7 mining stocks they bought. And I am going to give you your exact battle plan for the next 90 days. The manipulation is over. The surrender is filed. The proof is on the SEC website right now. This is the story of how JP Morgan lost the silver war. Let me show you the scale of what they bought. JP Morgan didn't nibble. They didn't test the waters. They deployed $8.73 billion in approximately 10 days. Look at the 7 companies they targeted. Wheaton Precious Metals, $2.9 billion investment, 9.2% ownership stake. Wheaton is a streaming company with contracts to buy 24 million ounces of silver annually at $5.83 per ounce. With silver at $72, that's a $66 per ounce built-in profit margin. Pan American Silver, $1.8 billion investment, 11.7% stake. Produces 23 million ounces annually from 7 mines across Mexico, Peru, Argentina, and Bolivia. First Majestic Silver, $987 million investment, 14.3% stake, making JP Morgan the largest shareholder. Produces 13 million ounces annually and controls 287 million ounces of proven reserves. Plus 4 more: Endeavor Silver, $542 million, Hecla Mining, $721 million, Mag Silver, $398 million, and Core Mining, $338 million. Total annual production these companies represent, 98.4 million ounces. Total reserves they control, 1.8 billion ounces. By spending $8.73 billion, JP Morgan secured exposure to nearly 100 million ounces of annual production and 1.8 billion ounces of in-ground reserves. They created a synthetic long position in physical silver by owning the companies that produce it. But here is what reveals the desperation: the timing. JP Morgan filed this 13F on Friday, December 26th, the day after Christmas. Markets barely functioning. Institutional traders on vacation. News coverage at annual lows. They buried this filing in the holiday dead zone, hoping nobody would notice. The filing deadline was Monday, December 29th. They could have waited. Instead, they filed on Friday afternoon of a holiday weekend. Why? because they wanted minimal attention when the world discovered the largest silver short in history just capitulated. Now look at when they actually bought these positions. The language in the 13F indicates the bulk of these purchases occurred between December 15th and December 24th. That is the exact period when the LBMA announced indefinite suspension, when China announced their January 1st export ban, when it became undeniable that physical silver markets had permanently fractured. JP Morgan watched the supply chain collapse in real time and panic bought $9 billion of mining stocks in 10 days. In part 2, I'm going to explain exactly why they did this and why it is the most desperate financial maneuver I have ever seen from a major bank. Stay tuned. If you are just joining us, JP Morgan just disclosed $8.73 billion in silver mining stock purchases, going from zero exposure to the largest institutional holder overnight. Now let me explain why they had no choice. JP Morgan has been short silver through futures, contracts, swaps, and over-the-counter derivatives for 15 years. Based on CFTC data and leaked internal risk reports, their net short position as of late December 2025 is estimated at 68 to 70 million ounces. At the current silver price of $72, their mark-to-market loss on that short position is approximately $2.8 billion. If silver goes to $100, which is now highly probable given the supply freeze and export bans, their loss would be $5.2 billion. That is a capital adequacy event that threatens their regulatory ratios, that risks FDIC intervention. JP Morgan cannot let that short position ride to $100. But they also cannot cover it by buying 70 million ounces of physical silver because physical silver does not exist in those quantities. The LBMA is offline indefinitely. London vaults are frozen. China banned exports January 1st. Switzerland locked down. There is no available supply of 70 million ounces anywhere on the planet at any price. So what do you do when you are short an asset you cannot buy? You flip long through a different mechanism. This is called position inversion. It is what you do when you are trapped with no way out. Here's the math. If silver goes to $100, JP Morgan's short position loses $1.96 billion. But their $8.73 billion mining stock portfolio does not move one-to-one with silver. Historically, silver mining stocks move 3 times to 5 times the percentage move of silver itself. If silver goes from $72 to $100, that is a 39% increase. If mining stocks move 3 times that percentage, they increase 117%. JP Morgan's $8.73 billion portfolio becomes worth approximately $18.95 billion. That is a $10.22 billion gain. Loss on short, $1.96 billion. Gain on mining stocks, $10.22 billion. Net profit, $8.26 billion. They converted a bankruptcy level loss into a multi-billion dollar profit through position inversion. Now look at the historical precedent, because this is not the first time we have seen this playbook. In 2008, Bear Stearns was massively short mortgage-backed securities when the housing market collapsed, and they realized they could not cover their shorts without bankruptcy. They did not try to buy their way out. They flipped long on housing through different vehicles and derivatives. It did not save them. The Fed still had to orchestrate the sale to JP Morgan, but it delayed the collapse by months. In 1998, long-term capital management was short volatility through massive derivative positions. When the Russian debt crisis spiked volatility globally, they could not close their positions. They inverted, went long volatility through options to hedge the short. The Fed still bailed them out, but the position inversion bought them time. JP Morgan is running the exact same playbook, short physical silver they cannot buy. So flip long through mining equities to hedge the exposure. It is a desperate move disguised as a strategic pivot. And here's the terrifying implication for the rest of the market. If JP Morgan has surrendered, who is left to suppress the price? For 15 years, whenever silver threatened to break out, JP Morgan would dump massive short positions to cap the rally. They were the market maker of last resort, the institution with deep enough pockets to absorb losses and maintain suppression. If JP Morgan is now long, there is no one left to fight the rally. HSBC abandoned their shorts in early December. Scotia Makata exited. Deutsche Bank exited. The bullion banks that coordinated suppression have all stepped away because they realized what JP Morgan just admitted. You cannot short a market with no physical supply. The shorts are now naked. There's no way to cover them. The only option is to flip long and ride the melt up. In part 3, I'm going to give you specific price targets for the miners JP Morgan bought and explain what happens when the other 200 global banks see this filing. Stay tuned. We have established that JP Morgan flipped from the largest short to the largest long through $8.73 billion in mining stock purchases. We have explained the position inversion math. Now let me tell you exactly what happens next and give you the price targets. The 13F filing is public. It is on the SEC website right now. Institutional investors Hedge funds and algorithmic trading systems scan these filings for signals. When they see that JP Morgan went from zero silver mining exposure to the largest institutional holder overnight, acquiring $8.73 billion in a single quarter, what do they conclude? They conclude that JP Morgan knows something. They conclude that the smart money is positioning for a massive move, and they follow. This creates a second wave of institutional buying in the mining sector. We are going to see a flood of capital into silver miners in January and February as institutions chase JP Morgan's positioning. Here are my specific price targets based on this catalyst. By January 15th, when hedge funds and institutional desks return from holiday break and digest this 13F filing, we see the first wave of copycat buying. Silver mining stocks rally 15 to 25% from current levels. First Majestic, currently $33.50. Target $40 to $45. Pan American Silver, currently $47.50. Target $55 to $62. Wheaton Precious Metals, currently $61.60. Target $70 to $77. By end of January, if silver breaks $85, as I expect due to the China export ban and private market defaults, mining stocks move 3 to 4 times that percentage gain. We are looking at 50 to 70% gains from current levels. First Majestic, $55 to $65. Pan American, $75 to $85. Wheaton, $90 to $100. By end of Q1, March 31st, if silver reaches $100, which the supply dynamics now make highly probable, and if other major banks follow JP Morgan's lead, which they must to avoid being left short, we see a full sector revaluation. First Majestic, $75 to $90. Pan American, $95 to $110. Wheaton, $115 to $130. These are not hype numbers. These are conservative projections based on historical leverage ratios between silver prices and mining stock valuations. But there is a second order effect that most people are missing. JP Morgan's stakes give them voting power. With 9% to 14% ownership in multiple miners, they can influence corporate decisions. They can push for production cuts to tighten supply further. They can push for strategic stockpiling of production rather than immediate sales. They can push for merger and acquisition activity to consolidate the sector and eliminate competition. JP Morgan is not just investing in miners. They're positioning to control the supply side of the silver market. If you control the companies that produce the metal, you control the flow of the metal. And if you control the flow, you control the price. Now, look at the broader context. On December 6th, the LBMA suspended operations. On December 10th, we documented JP Morgan's emergency meeting. On December 29th, the LBMA issued their indefinite suspension statement. On January 1st, China's export ban took effect. And on December 26th, buried in a holiday filing, JP Morgan disclosed they spent $8.73 billion to flip from short to long. This is the final act of the 15-year manipulation. They suppressed silver for a decade and a half to keep prices low for industrial users and prevent silver from competing with fiat currencies as a monetary asset. But the supply deficit caught them. The vaults emptied. The LBMA collapsed, and they found themselves short 70 million ounces of an asset with no functioning market. They cannot cover. They cannot deliver, so they surrendered and flipped long. They are now betting on the squeeze they created. In the final part, I'm going to give you your exact strategy for the next 90 days, whether you own physical, miners, or cash. Stay tuned for the conclusion. We have arrived at the end of this investigation. We have exposed JP Morgan's $8.73 billion surrender. We have explained the position inversion math. We have given you the price targets. Now, your battle plan. If you own physical silver, do nothing. Hold. JP Morgan just spent $8.73 billion to validate your thesis. The largest bear admitted they were wrong. The manipulation is over. The squeeze begins. Your only job is to not let them buy your metal from you at suppressed prices on the way up. When silver hits $100 and the mainstream declares it a bubble, remember this filing. Remember that JP Morgan positioned for this exact outcome. If you own silver mining stocks, you're sitting on the trade of the decade. Institutional buying pressure is about to hit this sector like nothing you have seen. Do not sell into the first 20% rally. That is just the appetizer. The main course is the 100 to 200% move that comes when Citigroup, Bank of America, and the other banks file their copycat positions in Q1. If you want to take profits, wait until March at minimum. Better yet, hold through the full revaluation. If you are in cash, you have a brief window to position before the herd arrives. The names JP Morgan bought are the obvious targets: First Majestic, Pan American, Wheaton. But do not chase them if they gap up 15% on Monday. Wait for a pullback or rotation day. The key is to be positioned before the Q1 13F filings reveal the second wave of institutional buying. You have roughly 60 to 75 days. But here's the most important thing. Understand what just happened at a deeper level. For 10 years, retail investors, gold bugs, and silver stackers have been mocked. The mainstream called you conspiracy theorists. Analysts said silver was a pet rock with no investment value. JP Morgan and the bullion banks fought you every step. You bought at $18. They smashed it to $14. You bought at $28. They smashed it to $22. You held through the crashes of 2020, 2023, and 2025. You endured the volatility, the manipulation, the psychological warfare. And now, JP Morgan just joined you. They deployed $8.73 billion to take the same side of the trade you have been on for years. The largest bear in history just became a bull. They admitted, with their capital, not their words, that you were right. This is not just about money. This is vindication. This is confirmation that the system you did not trust was exactly as broken as you thought. The vaults were empty. The shorts were naked. The manipulation was real, and it just ended. While the world was celebrating Christmas, you were reading 253-page SEC filings. While they were watching football, you were calculating position inversion math. While they were sleeping, you were connecting the dots between the LBMA collapse, the China export ban, and this surrender filing. This is pattern recognition. This is preparation. This is what separates those who survive market dislocations from those who get destroyed by them. You saw the 1.1 billion ounce deficit before the analysts admitted it. You saw the supply chain breaking before the media covered it. You saw the LBMA collapse before the mainstream noticed. And now you're seeing JP Morgan's capitulation before the institutions react to it. Tomorrow, when the headlines catch up and CNBC runs the story, when the Reddit forums explode and the Twitter threads go viral, you will already be positioned. You will already own the metal and the miners that everyone else is scrambling to buy. Because you were not waiting for permission. You were not waiting for confirmation. You were watching the data, following the money, and making decisions when it was uncomfortable. The white flag is flying. The manipulation is over. The largest short in history surrendered on page 112 of a Christmas weekend filing. Friday, December 26th, 2025, 4:01 p.m. Eastern. The day everything changed. JP Morgan spent 15 years suppressing silver. They spent $8.73 billion in 10 days buying silver miners. That is not a pivot. That is a panic. And if they are panicking to get long, what should you be doing? Subscribe. We just won.